From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, a Goldilocks jobs report for the Federal Reserve. Borrowers flood the bond market, and the world's pile of negative yielding debt finally vanishes. We begin with the big issue, another upside payroll surprise.
It's still a strong labor market.
Still hiring a lot of people.
Wage inflation is starting to ease.
Today's about, wage inflation.
Lowered wage growth.
Wage growth is down.
This has never happened before, where we've been able to bring the growth of wages down and the inflation rate down without having the unemployment rate go up.
You're clearly seeing an economy that's moderating.
It's constructive for the Fed.
This is the immaculate disinflation report.
A soft landing report.
Maybe we could get through this without a significant recession.
The Fed is likely to look at this and say, look, our medicine is working.
They're certainly going to continue to raise rates.
You can't write off another 50.
More likely that they go 25 basis points.
Relatively muted bond market reaction.
This is just 1 month's number.
You can't read too much into today's report.
Joining us now, we have Barclays Meghan Graper and Winnie Cisar of CreditSights. And let's start with the numbers. We beat on the headline jobs added. The unemployment rate dropped a little bit, and you also had average hourly earnings come in softer than expected. You add that together, Winnie, we're looking at a 17 basis point drop on the 2-year Treasury yield. Does that make sense when you parse through this report?
Well, as we parse through the report, it is definitely an encouraging print, I think, for the Fed and for market participants more broadly. Some of the trends are clearly showing some deceleration in terms of actual job adds to payrolls, also encouraging to see that participation rate increase. Now, we are a little bit concerned that the rates market reaction today has maybe been a little bit overdone. But then again, at the end of December, we did see another round of sell-off and more expectations for aggressive rate hiking. So I think we are just going to be trading in a little bit of this kind of day-to-day limbo, especially with CPI and more inflation data ahead of us next week.
And so, Meghan, if we look at terminal rate pricing for the Fed, it dipped to just below 5% in the aftermath of the report. Like we just walked through, a lot of action going on the front end of the curve. Winnie thinks maybe it's a little bit overdone. Do you agree?
Yeah, I think the market continues to play games here in terms of trying to evaluate what the Fed may or may not do. And now I think the difficult balance for Powell in the months ahead is going to be to try to continue on this path of moderation that they set into motion last month. But importantly, to try to accomplish that without triggering further easing of financial conditions. So the moves today feel a bit overdone to me. I think the Fed will be a bit disgruntled with the reaction. We rallied more in the first half of December than the Fed, I think, was ultimately comfortable with. We saw that in the Fed minutes this week, where that sentiment was sort of clearly expressed, sort of questioning whether or not the market was misconstruing the Fed's reaction functioning and their willingness to maintain a more restrictive stance in the coming months. I think they've done a pretty good job of trying to reinforce that commitment, but today's market action certainly probably is raising eyebrows on that count.
It's an important point when you think about the implications for financial conditions that rally has sparked. We're going to get to that in a moment, but I want to bring in DWS's group's Greg Staples. He's joining us now. And Greg, I want to come to you with a quote from Citi. Analysts there wrote that Fed officials are clearly growing more uncomfortable with the market underpricing their likely policy path. We continue to expect a 50 basis point hike in February. So let's talk about what actually happens next month. Do you think that today's report or any of the data that we got this week moves the needle for the meeting next month?
Well, first off, I'd say that today's headline in terms of data was supposed to be non-farm payrolls, and as we've touched, it was a mixed bag. Good news, at least in average hourly earnings and the weekly hours. But the ISM number 90 minutes later was the one that actually stole the show. It was much, much weaker than expected, and it wasn't until that print at 10 o'clock that the bond market really took off, and you saw the rally that you're seeing now. I agree with the previous guest. I think the market's gotten a little bit ahead of itself, but we still need to see the CPI data next week and see whether that corroborates the kind of weakness that we're seeing now. I think the conundrum for the Fed is that while the data is doing what they want it to do, and it's taking a little bit of the hawkish pressure off of them, then the market turns around and starts to ease financial conditions aggressively, whether warranted or unwarranted, and that just turns around and puts the Fed right back in the box where they have to remain hawkish.
Well, let's stick there with financial conditions, because in addition to all the data that we got this week, we also got minutes from the Fed's December meeting, and there were a lot of headlines. This one in particular caught my eye, that the Fed was wary of a, quote, unwarranted easing in financial conditions, right? What we're talking about now. And I guess, Winnie, when you think about that, you think about how the market is reacting, the data that we're getting. I mean, does that tilt the Fed to this more hawkish stance that Greg is talking about?
I think that the Fed has to maintain hawkish messaging at least through the first half of this year, especially when you just look at the annualization of inflation data and when base effects really kick in, which is kind of the first half of the year, and then when inflation data has kind of the make or break potential, which is midway through this year in June or July. That's when things are either going to plateau off at these higher levels or continue to come down nicely. And it feels like a long way between now and summer at this point, which means that the Fed is going to have to continue to telegraph this hawkish messaging. Whether that actually translates into outsized rate hikes, I think, is a little bit more up for debate. We've been in the camp that the Fed's going to hike another 25 basis points and then chill out there for basically the entirety of 2023. So these rapid rate cuts that are being priced into the market, we totally disagree with, and think that investors should keep in mind that keeping elevated policy rates is probably the most likely path for the Fed in the near term.
I really like that distinction that you made between hawkish messaging and actually hawkish actions. And Meghan, when you think about that distinction and the fact that we have seen financial conditions ease, especially on the heels of that rally in early December that you talked about, do you think that this translates into actual further hawkish actions beyond what they're currently forecasting right now? Or do you think that their main tactic will be jawboning?
No, at the end of the day, I mean, we saw it in recent Fed speak over the course of the week. We had Bostic, we had Bullard, we had George, all suggesting that they still have a ways to go and that they've had limited traction. So these are encouraging data points today, but I don't think it takes them off the baseline course. I think it's just another indication that the economy hasn't worsened enough to justify the Fed being comfortable with easier financial conditions. And, I think it's easy to lose sight of just how compressed this cycle has actually been. I mean, I think, it's inconceivable at the start of last year that we would see 4 consecutive 75 basis point hikes and then to wrap things up with a bow at 50 in the December meeting. So it's no real surprise to me that with only 2 CPI prints, 1 PCI to support that case, that they're not ready to give up yet, even though, sort of their more belated start here probably both consciously and deliberately ultimately sends us into a recession.
Well, as we put together the data with what we're seeing in the markets, what that means for financial conditions, it begs the question about what is actually going to play out in terms of volatility. And we heard from former U.S. Treasury Secretary Larry Summers. He spoke to Bloomberg Television after the jobs report, and he had a warning for bond investors.
This is going to be remembered as a V year when we recognized that we were headed into a different kind of financial era with different kinds of interest rate patterns.
He also said that he suspects that tumult will be one of the defining characteristics of bond markets in 2023. And Greg, it feels like that was the defining characteristic of bond markets in 2022, just the incredible volatility that we saw in the U.S. Treasury market, the biggest bond market out there. Is that going to be the setup for 2023 as well?
We actually don't think it's going to be the case. In 2022, you saw a 275 basis point range on the 10-year Treasury, 75 basis point range in investment-grade credit spreads. We think 2023 is going to be much more subdued there, perhaps 100 basis point range, think 3.25, 4.25 for the 10-year Treasury. There could be some volatility in there as the market works through the Fed and they're ultimately plateauing and then maybe even pivoting at the back end of the year. Yeah, you'll see inter-range volatility, but overall we think the range is a little bit narrower and you can actually play that in terms of adding value. I think volatility overall, though, is less than it is in 2022.
And when you think about adding value, where do you see the most value to be had in the U.S. Treasury market? Is it in the front end, or are you willing to maybe look at some long duration here?
Well, we particularly think that we're going to see some steepening. Obviously, the curve right now is very much inverted. 2s, 10s at -75, We think that's probably as close as it gets to its bottom there. And eventually it'll start to steepen as we start to see longer-term inflation expectations move from the 2 to 2.5 and 3% at a real yield of 150 basis points. On top of that, and you look at a 10-year Treasury, roughly around 4. The short end starts to rally as we get closer to the first Fed ease in 2024, so we see a steepening. All in, it pushes us a little bit short in terms of duration, much more positioned for a steepening, but we actually still think 2023 is going to be a year when more of your total rate of return is going to be coming from actual coupon yield rather than price movement. So we're emphasizing yield, higher grade, investment grade credit, particularly in the financial side, maybe a little bit of a discount in terms of mortgages and some structured finance as well.
All right, guys, we're just getting started. We have a great discussion on credit coming up next with Greg Staples, Meghan Graper, and Winnie Cisar. Everyone is sticking with us. Up next, it's the auction block where global bond sales took off to start this new year. The details next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where there is a global boom to start issuance in 2023. We start in Asia. There was a record start to the year. 8 borrowers sold a combined $25 billion of U.S. currency bonds. Over in Europe, same story. Primary weekly sales amounted to over 77 billion euros, the highest in almost a year and one of the best starts to a year on record. And here in the U.S., Caterpillar was part of the largest two-day bond binge in 16 months, with weekly total volume standing at $58 billion. Meanwhile, BlackRock's Rick Reeder anticipating a better year ahead for credit.
10-year average of the 1 to 3 year part of the aggregate index. The index is, I think the average is 1.18%. Now that index is about 4.5. So meaning you don't have to go out the yield curve, you don't have to go down into high yield, and you're getting a 4.5 just by sitting in 2-year things like investment grade credit, things like AAA securitized assets. This is a boon for fixed income investors, and you don't have to take nearly as much risk as we had in the past.
Still with us, Greg Staples, Meghan Graper, and Winnie Cisar. And that's the BlackRock view, that actually we're going to see high yield outperform. That's different from the consensus on Wall Street. The consensus there is that investment grade will actually break its 2-year losing streak against junk. But Meghan, what's your view when you look at IG versus high yield?
Yeah, at the end of the day, I think, the majority of the market is seeing investment grade as the most attractive sector in credit. And so not surprisingly, as was alluded to in that intro, we had a record-setting pace to start the year following what had been a very anemic $8 billion December. There's been a lot made of that uptick. I think it largely has been newsworthy because it stands in such stark contrast to a market that is disappointed to the downside in all but 4 weeks over the last 6 months, but not because it's particularly astounding in terms of historical January volumes. In fact, you tend to see about 44% of January new issuance materialize in this first week of the year. I think at the end of the day, where I see value is probably more so in investment grade as we think about the first half of the year, and that may be an evolving dynamic as we think about the ultimate path forward for high yield on the other side of the coin. But in my eyes, as we think about the potential for a recession ahead and the likely implication that has on credit spreads, I think investment grade is initially going to remain much more well supported through the end of the cycle here, as the return of both carry and income help to anchor demand and afford liquidity to the market in a way that we've yet to see on the high yield side of the equation. So at 533 on the investment grade corporate index, that's still a 200 basis point pickup to pre-COVID averages. To me, that's the more compelling near-term opportunity, even as that 8 3/4 high yield level might be viewed as compelling if we think inflation has peaked.
Winnie, do you agree with that? From where you're sitting, where's the better near-term opportunity?
So we have been very constructive on investment grade really for a couple of months now, and we actually also upgraded high yield to overweight with our 2023 outlook. I'm actually kicking myself. I wish I had done it a little bit sooner. And we think that the high yield market has a lot of things going for it. An almost 9% yield to worst feels pretty good. a good chunk of more stressed issuers priced like they are going to trade to a default this year feels pretty good. The fact that it's much higher in quality now than it has been historically, with lots of double Bs and still some rising star capital structures, that feels pretty good. Also, having a shorter duration is a net positive for high yield right now. Even if we continue to get some Fed rate hikes, if we see some U.S. Treasury curve steepening, that means that total returns in high yield should actually outperform investment grade. So we like both asset classes. We think they're both good for income generation, but from a pure return math perspective, we do think that high yield can have a much stronger performance than investment grade this year.
And Winnie, plenty would say that it's better to be late than early there. But Greg, as I'm looking over your notes, I see that you're a little bit of an outlier here because you're tactically underweight on credit. What would shift your stance? What would you need to see?
Well, if you're talking specifically IG credit, it's the fact that we've seen such a rally over the past 2 or 3 months from the wides that we saw in October that there's just not a lot of value left in it. Now, this is more of a tactical call. Seeing the kind of issuance that we saw early this week, 58 billion easily absorbed by the marketplace, tells us that there might be a lot more to come there. And we think when we're starting to see some weaker numbers economically in the first and second quarter, there potentially is a 10 or 15 basis point widening. But this is purely tactical. We don't think that there's any fundamental structural weakness in investment grade credit overall.
And you bring up supply, we got to talk about it. There's a lot of superlatives that I could list out here, but I'll stick with one number, the fact that total weekly U.S. issuance was $58 billion. And Meghan, I want to turn this question to you. Is this just a catch-up from a dry December? Or do you think that this is sustainable, this pace of issuance?
This is pretty true to seasonality for investment grade issuance. 70% of those volumes came from bank and finance names. Again, very consistent with historical patterns. 88% of that came from non-U.S. banks that had been relatively absent from the market over the fourth quarter of last year. I think ultimately at 58 billion, we're right on pace with expectations for January. If you get 44% of January volumes in that first week, we're right on target for 135 billion for the month. And beyond that, the 5-year average for the first week in January is 62 billion. So we actually fell short by a modest amount. I think that with some front loading, trying to get in ahead of the next Fed meeting, also trying those non-U.S. banks trying to get in ahead of the big six who have earnings towards the back end of next month kicking off, or back end of next week, kicking off. So trying to be a front run what will be a continuation of bank and finance supply over the course of the month. But all of that aligns with historical standards. There's no real anomalies as I think about what we've seen this week, with one exception, which is, if you think about the theme of front loading, many borrowers actually double dipped and appealed to issuance and investors in euros and sterling alongside of dollar issuance. So there's a view of take it while the going's good. And I think that's likely to continue to drive thematics in the primary market over the better part of the next 3 weeks.
And Winnie, we have just less than a minute left, but I want to get your thoughts on supply, because the explanation I got oftentimes last year for why credit spreads were so contained was just that there weren't many bonds to go around. We didn't have that supply. If we return to more normal levels, is that a recipe for spread widening?
Well, I have to say that last year, the IG market did price 1.2 trillion, which in a pre-COVID year would have been a very high number. And financials accounted for a large percentage of that. And financial spreads did see some pressure and volatility. So there were some pressure points related to new issue supply. We actually think that supply is going to continue to decrease over the course of this year. We're not surprised to see this kind of risk on new issue supply right out of the gates. But as we look ahead, we see less urgency in terms of new issue, why companies need to raise debt, all of those things.
All right, guys, great perspective, great conversation. We're going to continue it next. Greg Staples, Meghan Graper, and Winnie Cisar, everyone sticking with us. Still ahead, it's the final spread. The week ahead, another big data week coming up with the latest inflation print and big banks kicking off the earnings season. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, more Fed speak. We have Atlanta Fed President Raphael Bostic kicking us off on Monday. Then we have Chair Powell and Governor Bailey on deck on Tuesday. And the big day, the big data dump, it's CPI on Wednesday, along with another round of jobless claims. And finally, U.S. bank earnings kicking us off on Friday. Greg Staples, Meghan Graper, and Winnie Cisar are still with us. Before we get to the rapid fire round, I want to hear your thoughts for the week ahead. What's the big data point to watch? I'm going to start with you, Greg. What are you watching?
It's got to be CPI, and it's core CPI. We're going to see headline CPI come down. There's no question about it. But looking at core is going to be the key statistic.
Winnie, what about you? Is it CPI?
Totally agree with Greg. It has to be CPI. We, of course, are focused on consumer sentiment as well, but everyone is going to be laser focused on that CPI reading.
All right, Meghan, we've heard from our other two guests. It has to be CPI. Is that this case for you, or where do bank earnings fit in?
I think ultimately it is CPI. Bank earnings, obviously a precursor to what will likely be a continuation of new issue activity. But I think alongside of that CPI number, it's the Fed really needing to be vocal and continuing to hammer home their path forward. They'd regained control of that narrative in December. I think it's critical they continue to hammer home that exact same message over the course of the week.
Greg, any chance we hear from any of the Fed members stepping outside the party line, or is it more of the same?
I think it's going to be more of the same. They've got to stick to that. They can't show any deviance right now. No.
All right, it's time for the rapid fire round, guys. We have 3 questions, 3 quick answers. Winnie, I want to start with you. 25 or 50 basis points from the Fed in February?
25.
Meghan?
50.
Greg?
25.
All right, Winnie, is the terminal rate above or below 5%?
Below.
Meghan?
Above.
Greg?
Below.
All right, Meghan's the outlier. Last question, guys. Does investment grade or junk outperform in 2023, Winnie?
I prefer high yield to junk, and I believe that high yield's going to outperform.
Meghan, same question. Investment grade or junk?
Near-term investment grade, by year-end, high yield.
Greg?
Defined by excess returns, I'm going to say investment grade.
All right, fair enough. Guys, great conversation. Greg Staples, Meghan Graper, and Winnie Cisar. Great way to kick off the year. From New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.